Before you watch this video, I want to ask you for one small favor. If you're new here, please subscribe. I'm building this channel from the ground up, and every video takes hours of research, writing, and editing. My goal is to make videos that help you understand money, investing, psychology, and the economic changes happening around us. So if that sounds like something you want to watch, subscribe. It really helps me stay motivated and keep bringing you better videos. Now forget everything you think you know about 2027 for a moment, because there's a possibility that 2027 won't feel important when it begins. There may be no giant warning sign, no single day when everything changes, no headline saying, "The new financial era has officially started." And that is exactly what makes it interesting. Some of the biggest changes in financial markets begin quietly. First, a few numbers move. Then companies change their spending. Then investors change their expectations. And eventually, ordinary people realize that the environment they were making financial decisions in has completely changed. That may be what we need to watch as we approach 2027, because several powerful forces are beginning to overlap. And when they overlap, the outcome can become much bigger than any one of them individually. Start with something most people rarely think about: the price of money. For years, investors became accustomed to extremely cheap money. Then inflation changed everything. Central banks raised interest rates. Borrowing became more expensive, and suddenly an investment that looked attractive at low interest rates could look completely different at higher ones. Think about a company valued at $100 billion. If investors can earn relatively attractive returns from safer assets, they may demand much more from that company before paying a premium for its future growth. But if financial conditions become easier, investors may once again be willing to pay more for future earnings. That tiny change in the cost of money can influence stocks, housing, business investment, borrowing, and even consumer behavior. And this is why the direction of inflation matters so much. The Federal Reserve's June 2026 projections put median core PCE inflation at 2.5% for 2027. That is not a guarantee. Forecasts change. Unexpected events happen. But it tells us something important about the environment policymakers are currently expecting. A world of gradually cooling inflation could look very different from the inflation shock that dominated the beginning of this decade. And then there's another force entering the equation: artificial intelligence. But here's where you need to be careful. The AI story has two completely different sides. On one side, companies are investing enormous amounts into computing power, chips, data centers, energy, software, and automation. If AI genuinely increases productivity, companies could produce more with fewer resources. That could increase profits. It could change how businesses operate. It could create entirely new products and industries. And it could make some companies dramatically more valuable. But there is another side. What happens if investors become so excited about AI that expectations move faster than reality? That's when psychology becomes important. Imagine a company announces that it is spending billions on AI infrastructure. The market gets excited. Its stock rises. Other companies announce similar investments. Investors start believing the entire sector is going to explode. More money enters. Prices rise further. And suddenly, the question changes. People stop asking, "Is this business creating real economic value?" They start asking, "How much higher can this stock go?" That is a very different question. And history shows why it matters. Investing becomes dangerous when people stop evaluating an asset and start simply assuming someone else will pay more for it tomorrow. This doesn't mean AI is a bubble. It doesn't mean AI is going to collapse. It means something much more interesting. A revolutionary technology can be real, while some investments connected to it can still become overpriced. Both things can be true at the same time. And that distinction could become increasingly important as we approach 2027, because eventually, the market will demand evidence. Not promises, not excitement, not futuristic presentations. Results: revenue, profit, productivity, cash flow, and actual economic value. Now add another problem to the picture: debt. Governments have accumulated enormous amounts of debt, and high interest rates make that debt more expensive to service. Imagine you borrowed money when the interest rate was low. Years later, you have to refinance. If the new rate is significantly higher, your payments can become much larger even though you haven't borrowed another dollar. Governments face a similar problem on a much larger scale, and companies face it too. This is why interest rates are not simply a number appearing on a financial news channel. They influence the cost of maintaining the entire financial system. And when debt, inflation, interest rates, and investment all interact, financial markets can become extremely sensitive to changes in expectations. Now imagine two possible versions of 2027. In the first version, inflation continues moving towards central bank targets. Economic growth remains relatively stable. AI investment begins producing meaningful productivity gains. Financial conditions become less restrictive. Businesses earn more money. Investors become more confident. That could create a very different environment for risk assets. But there is another possibility. Inflation refuses to disappear. Interest rates remain higher for longer. AI spending fails to produce the profits investors expected. Debt costs continue rising. Geopolitical problems increase uncertainty. Suddenly, the same investors who were willing to pay enormous prices for future growth begin demanding proof. And when expectations change, markets can move quickly. This is why I don't think the smartest way to think about 2027 is, will the market crash? Or, which stock will explode? Those questions are too narrow. The better question is, what kind of financial environment are we moving into? Because that determines how almost everything else behaves. And there's one more piece that could be even more important than all the economic data. You, the investor. Human beings have a strange relationship with money. When markets are falling, people want safety. When markets recover, they want proof. When markets rise for a long time, they want more. And when something becomes extremely popular, they often buy it precisely because everyone else is buying it. That is FOMO. And FOMO can turn an investment decision into an emotional decision. The reverse happens during crashes. An asset can become fundamentally more attractive after falling 30%. But psychologically, it can feel much more dangerous. That is the paradox of investing. The price can become more attractive while your brain becomes less willing to buy. And this is why major financial shifts are often difficult to recognize in real time. The data may be changing before the story changes. The economy may be changing before the headlines change. And investor behavior may change before either one becomes obvious. So as we move toward 2027, don't just watch the stock market. Watch inflation. Watch interest rates. Watch corporate earnings. Watch AI spending versus actual results. Watch government debt. Watch credit conditions. But most importantly, watch expectations. Because markets don't only react to what happens. They react to the difference between what people expected to happen and what actually happens. That difference can create opportunities. It can also create disasters. And maybe that is what makes 2027 so fascinating. It may not be about one giant event. It may be about a transition from one financial environment into another, from expensive money toward potentially easier conditions, from AI excitement toward the difficult test of actual profitability, from aggressive speculation toward greater attention to fundamentals, and from investors simply following yesterday's winners toward figuring out where tomorrow's value could actually come from. But remember something. By the time a major financial shift becomes obvious to everyone, it may already be reflected in prices. That's why you shouldn't wait for a headline to tell you that something has changed. Learn to recognize the signals before the story becomes popular. Because the biggest advantage in investing isn't having a crystal ball. It's understanding what you're looking at. 2027 could bring stronger growth. It could bring disappointment. It could bring a major market opportunity. It could bring a painful correction. Nobody can honestly tell you which one is guaranteed. But the forces building right now are powerful enough that ignoring them would be a mistake. And if you learn to understand money through economics, markets, and psychology instead of emotion, you become much harder to surprise. So don't ask me what the market will do in 2027. Ask a better question. What would have to happen for the market to change direction? Then start watching those things. Because the next major financial shift probably won't arrive with a giant sign saying, "This is it." It will begin with small changes that most people ignore. And by the time everyone notices, the story may already be much bigger than it was at the beginning.